In Florida, the average homeowner now pays more than double the national rate for insurance. Hurricanes cost $100 billion in damages, insurers flee, and families drop coverage entirely. Between 2020 and 2025, Florida averaged nearly $7 billion weather disasters each year. But nothing rivaled the scale of Ian. Insurers, reinsurers, and government agencies all cite Ian's $112 billion figure as the single turning point for the state's insurance market. Of that total, more than $65 billion was paid out in insured losses, checks written to homeowners, landlords, and businesses struggling to rebuild. The Florida Office of Insurance Regulations filings show a steady upward curve in rate requests, with insurers citing not only catastrophic storm losses, but also the rising cost of rebuilding. Construction inflation surged 35% since 2020, driven by supply shortages and higher labor costs. For insurers, every claim now carries a much bigger price tag, and replacement values, written into policies, are recalculated upward year after year. The pressure is compounded by the outlook for future storms. NOAA's climate projections warn that hurricanes affecting Florida are becoming more intense and, in many cases, more destructive. Catastrophe models used by insurers now predict that annualized losses for Florida properties could be 10 to 40% higher than they were a decade ago. These models feed directly into the rate filings that land on regulators' desks and ultimately into the premiums homeowners pay. Loss ratios, the percentage of premiums that must be paid out in claims, spiked after each major storm, but especially after Ian. While Florida's Office of Insurance Regulation does not publish aggregated loss ratio data for every year, the pattern is clear in company filings. When losses consistently exceed premiums, insurers must raise rates, restrict coverage, or leave the market entirely. By 2022, several carriers reported loss ratios well above 100%, signaling that claims outstripped the money coming in. This cycle of actuarial stress set the stage for the wave of insurer withdrawals and non-renewals that would follow. For homeowners, the result is a market where premiums rise faster than wages, and the cost of simply keeping a roof insured can threaten financial stability. The pressure on Florida's insurance system is not just a story of past storms. It is a warning about the cost curve of the future, shaped by climate, construction, and the hard math of risk. More than 30 insurance companies filed exit paperwork with Florida's Office of Insurance Regulation in the months after Hurricane Ian. The filings, some just a few pages long, spelled out a blunt reality. The risk was too high. The math no longer worked. Names familiar to agents and homeowners, UPC, FedNat, TypeTap, began vanishing from rate sheets and coverage maps. Each departure left agents scrambling to find alternatives for thousands of policyholders, often with just weeks' notice before renewals lapsed. Emails and board resolutions reviewed by regulators show a pattern. Companies cited mounting losses, soaring reinsurance costs, and legal expenses as reasons for pulling out. Some carriers stopped writing new business altogether, while others withdrew from entire counties, especially along the coasts. Broker networks in Miami-Dade, Orlando, and Tallahassee found themselves flooded with desperate calls as agents tried to place coverage for clients whose policies were suddenly non-renewed. For these households, one hurricane or fire could mean financial ruin. Many are retirees on fixed incomes, families in modest homes, or recent buyers who stretched to afford their property only to find insurance costs doubling or tripling in a matter of years. The risk is not evenly spread. In some neighborhoods, especially along the coasts, entire blocks have gone bare, neighbors relying on luck and hope instead of a policy. Yet in a twist that defies the broader trend, a handful of barrier island communities saw their premiums fall in 2025. Places like parts of Sanibel and Marco Island recorded drops of 20 to 25%. an outcome driven by a rare combination of aggressive wind mitigation upgrades, new insurer entrants, and state-mandated credits. For most of Florida, though, these exceptions are out of reach. Inland and lower-income areas see little relief, and the vast majority of homeowners face a stark choice: pay the rising bill or risk going without. The uneven patchwork of coverage has left the state more exposed than ever. For every island resident who caught a break, thousands more are now one disaster away from losing everything. As the number of uninsured climbs, so does the potential for personal and economic catastrophe. Citizens Property Insurance, Florida's state-backed insurer of last resort, has become the backbone for homeowners who can't find coverage anywhere else. After a wave of private insurer exits, Citizens' policy count soared to 1.4 million in the fall of 2023, a record high that dwarfed its pre-crisis size. Each new storm, each non-renewal, pushed thousands more into Citizens' growing pool. But the safety net is stretched thin. Public filings and regulatory data reveal that Citizens now carries a level of exposure once unthinkable for a single insurer. Its liabilities run into the tens of billions, and in the event of another major hurricane, the question of whether it could pay all claims looms large over Florida's budget planners. The strain isn't just about numbers. Citizens' claims handling has come under scrutiny, with more than half of policyholders reporting claims closed without payment in some years. Official regulatory data puts Citizens' outright denial rate between 13% and 17% for 2023 and 2024. Still higher than most national benchmarks, and a source of mounting frustration for homeowners. The reasons range from disputes over wind versus flood damage to documentation gaps that leave families in limbo. In coastal counties like Miami-Dade and Lee, the volume of denied or unpaid claims is especially acute, fueling a sense of insecurity even among those who manage to keep their coverage. Citizens' leadership points to efficiency gains, faster claim closures, and efforts to depopulate its roles by shifting policies back to private carriers. With the average Florida policy on track to exceed $15,000, the state's insurance market has become a warning sign for the rest of the country. The Senate's memo frames the situation in stark terms. Without major intervention, Florida could face a housing crash worse than 2008, triggered not by bad loans, but by the simple inability to insure a home. The numbers tell a story of urgency, and the consequences could reach far beyond the Sunshine State. In 2025, Florida homeowners pay an average of $5,376 per year for home insurance, more than double the national average. Over 30 insurance companies have left the state since Hurricane Ian, which caused $112 billion in damage, the largest loss in Florida's history. Policies have risen 72% in 5 years, and 15 to 20% of Floridians have dropped coverage entirely. While recent reforms brought 15 new insurers and some rate relief in select areas, the Senate Budget Committee warns that high premiums, falling home prices, and mortgage rates could trigger a housing crash worse than 2008. Citizens Property Insurance, now Florida's largest insurer, denied more than half of its claims last year, and legal costs remain the highest in the country. It remains unclear whether current reforms and new entrants will stabilize the market, or if future storms will erase recent gains. As of October 2025, the facts show a market still in crisis, with risks that extend beyond Florida's borders and no guarantee of lasting relief.